is via the ETFs and via direct silver companies compared with the last time silver was at this price on the way up. If you held a portfolio of these companies, diversified, or the ETF, you would have less value today.
The conversation presents a comprehensive analysis of the current state of the gold and silver markets, arguing that recent price weakness should not be mistaken for the end of the long-term bull cycle, but instead may represent a prolonged consolidation phase that is quietly building the foundation for a much larger move in the future. Throughout the discussion, the central theme revolves around the difference between short-term market sentiment and long-term structural momentum, emphasizing that investors who focus exclusively on daily price fluctuations often fail to recognize the deeper trends developing beneath the surface. According to the analysts, many bearish traders expected silver's dramatic correction from its highs to continue into a complete collapse, with widespread predictions calling for prices to revisit levels in the 50s before any meaningful recovery could occur. However, despite months of selling pressure and repeated attempts to drive the market lower, silver has consistently demonstrated remarkable resilience by finding buyers every time prices enter lower trading zones. This repeated pattern suggests that long-term investors continue accumulating physical metal while speculative sellers struggle to generate enough momentum to produce the kind of structural breakdown typically associated with the beginning of a prolonged bear market. Rather than collapsing, silver has spent months moving sideways, frustrating both bullish and bearish traders while quietly establishing what some believe could become the launching point for another significant advance. The discussion emphasizes that unless bearish participants succeed in forcing a decisive breakdown in the immediate future,
the opportunity may disappear entirely as the market gradually regains upward momentum and leaves many traders behind. This perspective reflects a broader understanding of commodity cycles, where extended periods of consolidation often precede powerful breakouts that catch the majority of investors by surprise because sentiment has become overwhelmingly negative. A significant portion of the analysis focuses on technical indicators, particularly moving averages and momentum structures, while cautioning viewers against placing too much importance on isolated technical signals without considering their broader context. Gold's recent movement below its widely watched 200-day moving average attracted considerable attention among market participants, but the analysts argue that such an event carries little significance because the market has not previously established repeated interactions with that level capable of creating meaningful structural importance. In contrast, the 50-day momentum indicator receives greater emphasis because gold has repeatedly approached it, failed to break through, retreated, and then returned again, creating a recognizable pattern that could become highly significant if eventually overcome. The analysts explain that genuine technical signals emerge from repeated behavioral structures rather than single price movements, meaning that a successful breakout above a level tested multiple times may represent a substantial shift in market psychology. This distinction illustrates why experienced observers often focus more on momentum than on price itself, recognizing that underlying strength or weakness frequently develops long before becoming visible through conventional chart analysis. Investors who rely solely on simplistic interpretations of moving averages risk misunderstanding the true condition of the market and making decisions based upon temporary noise rather than meaningful structural changes. Another fascinating element explored throughout the conversation involves the relationship between declining momentum readings and relatively stable prices. Although various momentum measures have weakened for several months, neither gold nor silver has experienced the kind of sustained collapse many bearish analysts predicted. Gold remains relatively close to the levels where the correction initially began, while silver continues oscillating within a broad range despite periods of intense volatility. This divergence suggests that although enthusiasm has diminished temporarily, underlying demand remains sufficient to prevent significant deterioration. The speakers argue that such behavior is characteristic of congestion phases occurring within larger bull markets rather than evidence that the broader trend has reversed. Historical examples reinforce this interpretation by demonstrating that many successful long-term advances include extended periods during which prices appear stagnant while underlying market conditions gradually improve. During these intervals, impatient investors often abandon positions in frustration, only to watch the market resume climbing once consolidation concludes. The discussion therefore encourages viewers to distinguish between temporary pauses and genuine reversals by focusing on long-term structural evidence rather than emotional reactions to daily fluctuations. Investor psychology emerges as another recurring theme, particularly regarding silver's ability to attract persistent buying whenever prices decline into lower trading ranges. Each correction appears to generate renewed accumulation from participants who remain confident in the broader bullish thesis despite widespread fear and uncertainty. While many traders react emotionally to falling prices by selling positions or delaying purchases, patient investors quietly absorb available supply, creating underlying support that repeatedly prevents extended collapses. The analysts interpret this behavior as evidence that ownership continues migrating toward stronger hands less concerned with short-term volatility and more focused on long-term value. Commodity markets have historically displayed similar dynamics, where prolonged corrections transfer assets from impatient participants to disciplined investors before major rallies resume. Every unsuccessful attempt to force prices dramatically lower potentially strengthens future advances because available supply becomes increasingly concentrated among holders unwilling to sell at discounted levels. As a result, once buying pressure intensifies again, prices may rise rapidly due to limited willingness among existing owners to part with their positions. Institutional investment trends provide additional context supporting the long-term outlook presented during the discussion. Several prominent financial institutions and respected strategists have begun challenging the traditional 60% stock and 40% bond allocation model that has guided portfolio management for decades. Concerns surrounding government debt levels, inflation, fiscal deficits, monetary policy, and geopolitical instability have encouraged recommendations to increase exposure toward commodities and precious metals while reducing dependence on conventional fixed-income assets. Despite these strategic discussions occurring at senior levels within major financial organizations, implementation across broader investment management divisions appears surprisingly limited. Many advisors responsible for overseeing enormous client portfolios remain unfamiliar with evolving institutional perspectives and continue following established allocation practices. This disconnect suggests that widespread institutional participation in precious metals may still be in its infancy despite increasingly favorable commentary from influential analysts. Should large-scale portfolio adjustments eventually occur, even relatively modest allocation increases could generate substantial demand because of the enormous size of global investment assets. The conversation therefore proposes that current institutional ownership may significantly underestimate future potential if macroeconomic conditions continue encouraging diversification into tangible stores of value. Physical demand for precious metals also receives considerable attention, particularly regarding gold deliveries and inventory movements within exchange systems. Large quantities of metal continue standing for delivery while substantial volumes reportedly leave vaulting facilities despite relatively subdued market prices. Such behavior indicates ongoing interest among buyers seeking physical ownership rather than merely paper exposure through derivatives. Historical commodity markets have frequently exhibited similar divergences where physical accumulation intensified quietly before visible price appreciation occurred. Investors concentrating exclusively on futures markets sometimes overlooked tightening supply conditions until shortages became impossible to ignore and prices adjusted abruptly. Although the analysts emphasize momentum analysis over inventory statistics, they acknowledge that continued physical demand strengthens confidence in the long-term case for precious metals by demonstrating persistent real-world interest despite temporary weakness in paper markets. Silver's expanding industrial significance represents perhaps the most compelling structural argument supporting future appreciation. Unlike gold, whose primary function centers on monetary preservation and investment demand, silver occupies a unique dual role combining financial characteristics with indispensable technological applications. Modern economies require silver for renewable energy infrastructure, semiconductors, electric vehicles, telecommunication systems, artificial intelligence hardware, medical equipment, aerospace engineering, and countless electronic components due to its exceptional conductivity and unique physical properties. As governments accelerate clean energy transitions and corporations expand advanced manufacturing capabilities, industrial consumption may continue rising independently of investment flows. Simultaneously, economic uncertainty could encourage additional monetary demand from investors seeking protection against inflation or financial instability. This convergence of industrial necessity and monetary appeal creates conditions where multiple demand sources compete for limited supply, potentially generating powerful long-term upward pressure if production growth fails to keep pace. The analysts therefore argue that silver should increasingly be viewed not merely as a precious metal but as a strategically important industrial resource essential to future technological development. Historical momentum analysis further reinforces the optimistic interpretation presented throughout the discussion. Previous major turning points in gold markets displayed unmistakable structural changes within long-term annual momentum indicators, signaling genuine transitions from bull markets to bear markets or vice versa. Following the peak more than a decade ago, annual momentum clearly broke established support patterns, confirming a prolonged downturn. Similarly, the subsequent recovery began with equally obvious structural improvements visible across longer time frames. Current conditions, however, exhibit no comparable deterioration according to the methodology employed by the analysts. Although intermediate momentum has weakened and prices have fluctuated significantly, annual structures remain broadly intact, suggesting that the present environment resembles a correction within an ongoing secular advance rather than the beginning of another extended decline. This perspective encourages patience because meaningful long-term trends often survive substantial short-term volatility without suffering permanent damage. Investors capable of distinguishing between temporary corrections and structural reversals may therefore avoid costly decisions driven by emotional responses rather than objective evidence. The broader macroeconomic environment provides additional support for maintaining interest in precious metals. Governments worldwide continue carrying historically elevated debt burdens while central banks navigate increasingly complex policy challenges involving inflation, economic growth, employment, and financial stability. Geopolitical tensions remain elevated across multiple regions, strategic competition intensifies, defense spending increases, and technological transformation accelerates through investments in artificial intelligence, renewable energy, and advanced manufacturing. Within such an environment, tangible assets possessing both historical monetary significance and practical industrial utility naturally attract attention from investors seeking diversification and resilience. Gold continues benefiting from centuries of recognition as a store of value during uncertain times, while silver combines similar characteristics with expanding industrial relevance driven by technological innovation. The discussion therefore frames precious metals not simply as speculative investments but as assets positioned at the intersection of monetary policy, industrial development, and geopolitical change. Another recurring lesson concerns the importance of discipline and long-term thinking. Markets frequently tempt participants to trade every fluctuation, yet history demonstrates that attempting to time corrections and recoveries precisely often results in missed opportunities and emotional frustration. Investors who sell during periods of weakness may struggle psychologically to re-enter positions once prices begin rising again, causing them to miss significant portions of broader advances. Likewise, waiting indefinitely for lower prices can leave capital uninvested while markets unexpectedly recover. The analysts repeatedly emphasize understanding the larger picture rather than becoming consumed by short-term volatility. Successful investing, they suggest, depends less upon predicting every market movement than upon identifying enduring structural trends and maintaining conviction when temporary setbacks occur. Finally, the discussion addresses ambitious long-term price projections for silver, acknowledging that targets reaching several $100s per ounce may initially appear unrealistic.
However, commodity history contains numerous examples where markets exceeded prevailing expectations once long-standing resistance levels gave way and supply-demand imbalances intensified. Silver itself spent decades confined within broad trading ranges before eventually breaking into substantially higher territory. The recent correction from $120 is therefore interpreted not as proof that higher valuations are impossible, but as a cleansing event occurring within a much larger revaluation process. Whether such extraordinary projections ultimately materialize remains uncertain, but the analysts argue that investors should remain open to possibilities supported by evolving structural conditions rather than anchoring expectations exclusively to historical price ranges. In conclusion, the conversation presents a compelling case that the precious metals market remains in transition rather than decline. Gold and silver continue demonstrating characteristics consistent with long-term consolidation despite short-term volatility, while institutional discussions, physical demand, industrial consumption, macroeconomic uncertainty, and historical momentum analysis collectively support a constructive outlook. Rather than allowing temporary weakness to dominate perceptions, investors are encouraged to examine broader structural developments shaping future opportunities. The unfolding story extends beyond individual price movements to encompass changing monetary systems, technological progress, geopolitical realities, and evolving investment philosophies. Those willing to focus on these deeper forces may discover that the most important developments often occur quietly, long before markets fully recognize their significance. As we bring this extensive discussion to a close, the most important takeaway is that the precious metals market appears to be telling a story that extends far beyond daily price fluctuations or short-term technical corrections. Throughout this analysis, we have explored a wide range of factors influencing gold and silver, including long-term momentum, institutional positioning, physical demand, industrial consumption, macroeconomic uncertainty, investor psychology, and historical market behavior. When all of these elements are viewed together rather than in isolation, they present a picture that many analysts believe is far more constructive than the recent volatility might suggest. Instead of signaling the end of the bull market, the repeated periods of weakness may simply represent another stage in a longer process of consolidation, allowing the market to digest previous gains before determining its next major direction. History has shown repeatedly that the strongest advances rarely occur in a straight line. They often emerge after extended periods of doubt, frustration, and uncertainty when the majority of participants begin questioning whether the original bullish thesis still holds. Gold and silver have demonstrated this pattern many times over the decades, testing investor conviction through violent corrections before eventually resuming their broader trends. According to the perspective presented throughout this discussion, current conditions appear remarkably similar, with momentum resetting while long-term structural support remains largely intact. Rather than witnessing a complete collapse, the market has continued to attract buyers whenever prices weaken significantly, suggesting that underlying confidence remains stronger than many headline narratives imply.
One of the most significant observations made during this analysis is the resilience shown by silver despite months of persistent bearish expectations. Following its dramatic correction from previous highs, many market participants confidently predicted that prices would continue falling into much lower territory, expecting panic selling and widespread capitulation to force another major decline. Instead, every meaningful retreat has been met with renewed buying interest, preventing sustained weakness and keeping the market within a broad consolidation range. This repeated pattern suggests that patient investors continue viewing lower prices as opportunities rather than reasons for fear. Such behavior often characterizes markets where long-term demand remains healthy even though short-term sentiment has turned negative. In many historical commodity cycles, similar accumulation phases occurred quietly before substantial rallies developed, transferring ownership from emotional traders to disciplined investors with greater conviction. Every unsuccessful attempt by sellers to force a decisive breakdown potentially strengthens the eventual recovery because available supply gradually becomes concentrated among holders unwilling to sell at discounted prices. Once buying pressure eventually overwhelms remaining sellers, price appreciation can accelerate far more rapidly than most observers expect. Technical analysis also provides important insights into the current environment, although the discussion emphasizes that technical indicators must always be interpreted within their broader structural context. Widely followed measures such as the 50-day and 200-day moving averages frequently dominate financial headlines, encouraging investors to assume that crossing these levels automatically confirms bullish or bearish trends. However, experienced analysts argue that such assumptions often oversimplify market behavior. A moving average acquires genuine significance only after repeated interactions establish recognizable support or resistance structures. Gold's movement beneath certain averages therefore carries limited importance if the market has not historically respected those levels. Far more meaningful are situations where momentum repeatedly tests the same boundary before finally breaking through, indicating a shift in underlying psychology. This structural approach encourages investors to look beyond isolated chart signals and instead examine how markets behave over extended periods. The distinction may appear subtle, but it can dramatically influence investment decisions because temporary fluctuations often generate misleading conclusions when viewed without historical perspective. Another remarkable aspect highlighted throughout the conversation concerns the divergence between weakening momentum indicators and relatively stable price action. While various momentum measures have trended downward for months, gold and silver remain surprisingly close to the levels where their corrections initially began. Such stability suggests that although enthusiasm has diminished temporarily, underlying demand continues absorbing available supply sufficiently to prevent structural deterioration. Instead of collapsing under selling pressure, prices have largely moved sideways, creating frustration for both optimistic investors waiting for new highs and pessimistic traders expecting dramatic declines. According to the analysts, this behavior resembles previous congestion phases observed during larger bull markets rather than the beginnings of prolonged bear cycles. Historical examples reinforce this interpretation by showing that lengthy periods of consolidation frequently preceded powerful breakouts once market conditions aligned. Investors who abandoned positions during those earlier consolidations often found themselves unable to re-enter before prices accelerated higher, illustrating the challenge of distinguishing temporary pauses from genuine reversals. Investor psychology represents another central theme running throughout the discussion. Markets rarely move solely because of economic data or technical indicators, they are also driven by human emotion, expectations, fear, greed, and confidence. Silver's repeated ability to attract buyers whenever prices decline into lower ranges demonstrates that many participants remain focused on long-term value rather than immediate volatility. While headlines emphasize weakness and uncertainty, disciplined investors quietly continue accumulating positions based upon broader structural considerations. This behavior contrasts sharply with emotional selling often observed among less experienced traders reacting impulsively to short-term price movements. Commodity markets throughout history have repeatedly exhibited similar dynamics where corrections serve primarily to transfer assets from impatient owners to stronger hands before substantial rallies resumed. By understanding these psychological processes, investors may become better equipped to navigate periods of uncertainty without allowing temporary fear to dominate long-term decision-making. Institutional investment trends provide further evidence supporting the possibility of continued strength in precious metals. For decades, conventional portfolio construction emphasized balancing stocks and bonds according to the familiar 60-40 allocation model. However, growing concerns surrounding sovereign debt, inflation, monetary policy, fiscal deficits, and geopolitical instability have encouraged several influential strategists to recommend increasing exposure toward commodities and precious metals while reducing bond allocations. Although implementation remains gradual, the mere existence of these recommendations reflects changing attitudes within major financial organizations. Institutional investors rarely alter portfolio strategies quickly because internal processes, regulatory considerations, advisor education, and client communication require substantial time. Consequently, public recommendations may precede widespread action by months or even years. If broader implementation eventually follows current strategic discussions, even relatively modest allocation increases could generate enormous demand due to the vast scale of global investment assets. The discussion therefore suggests that precious metals may still occupy only a small fraction of institutional portfolios despite increasingly favorable long-term assessments. Equally compelling is the ongoing divergence between physical demand and paper market pricing. Large quantities of gold continue standing for delivery while significant volumes leave exchange storage systems despite relatively subdued prices. Such activity indicates that real-world buyers remain willing to acquire physical metal regardless of temporary market sentiment. Commodity history includes numerous examples where physical accumulation quietly intensified long before futures prices responded. Investors concentrating exclusively on paper markets sometimes overlooked tightening supply conditions until shortages became obvious and prices adjusted rapidly. Although momentum analysis remains the preferred methodology discussed throughout the conversation, persistent physical demand nevertheless strengthens confidence that underlying interest in precious metals remains robust despite periods of apparent weakness. Silver's industrial importance adds another dimension distinguishing it from many other investment assets. Unlike gold, which primarily serves monetary and wealth preservation functions, silver occupies a unique position as both a precious metal and an essential industrial material. Modern technologies depend upon silver for renewable energy infrastructure, photovoltaic systems, semiconductors, artificial intelligence hardware, advanced electronics, electric vehicles, telecommunications equipment, aerospace engineering, and medical applications. Its unmatched conductivity and specialized physical properties make substitution difficult across many critical industries. As governments pursue ambitious energy transitions and corporations expand technological capabilities, industrial demand for silver may continue increasing regardless of investor sentiment. Should monetary demand simultaneously strengthen during periods of financial uncertainty, silver could experience simultaneous pressure from multiple sources while supply growth remains constrained. Such conditions have historically supported extended commodity bull markets whenever production struggled to satisfy expanding consumption. Long-term momentum analysis further reinforces the constructive outlook presented throughout the discussion. Previous major market tops in gold displayed unmistakable structural deterioration visible across annual momentum indicators, providing clear evidence that broader trends had changed direction. Similarly, historical bottoms emerged alongside equally obvious improvements in long-term momentum before prices fully recovered. According to the methodology applied here, no comparable structural damage currently exists despite intermediate volatility. Instead, annual momentum remains broadly supportive while shorter-term weakness appears confined to congestion within an ongoing secular advance. This interpretation encourages patience because meaningful long-term trends often survive substantial corrections without losing their underlying integrity. Investors capable of distinguishing between temporary turbulence and genuine structural reversal may therefore avoid decisions driven primarily by emotion rather than objective analysis. The broader macroeconomic backdrop also deserves careful consideration. Governments worldwide continue operating with historically elevated debt burdens while central banks navigate difficult policy challenges involving inflation, growth, employment, and financial stability. Geopolitical tensions remain elevated across numerous regions, strategic competition intensifies, defense expenditures increase, and technological transformation accelerates through investments in artificial intelligence, renewable energy, and advanced manufacturing. Within such an environment, tangible assets possessing both monetary significance and practical industrial utility naturally attract renewed attention. Gold continues serving as a traditional store of value during uncertain times, while silver benefits from expanding technological relevance in addition to its monetary heritage. Together, these characteristics position precious metals uniquely within the evolving global financial landscape. Another valuable lesson emerging from the conversation concerns the importance of discipline and perspective. Financial markets often tempt participants to trade every correction, anticipate every reversal, and respond immediately to every headline. Yet experience demonstrates that consistently timing such movements proves extraordinarily difficult even for seasoned professionals. Investors who repeatedly sell during weakness frequently struggle to repurchase positions before recoveries accelerate, causing them to miss substantial portions of broader advances. Likewise, waiting indefinitely for lower prices may leave capital uninvested while markets unexpectedly recover. The discussion therefore advocates focusing on long-term structural understanding rather than attempting to predict every short-term fluctuation. Patience, preparation, and disciplined analysis often produce superior outcomes compared with emotionally driven reactions to temporary volatility. Ambitious long-term projections for silver understandably generate debate because they imply valuation significantly exceeding historical norms. Nevertheless, commodity history repeatedly demonstrates that markets can experience extraordinary revaluations once long-standing resistance levels break and supply-demand imbalances intensify. Silver itself spent decades fluctuating within broad ranges before eventually surpassing expectations during previous advances. Whether future prices ultimately achieve the optimistic targets discussed remains uncertain. But dismissing such possibilities entirely may underestimate the transformative effects of evolving industrial demand, institutional participation, and macroeconomic conditions. Investors should therefore remain open-minded while recognizing that forecasting inherently involves uncertainty and that responsible decision-making requires balancing optimism with prudent risk management. Ultimately, this analysis encourages viewers to think independently rather than relying exclusively on prevailing narratives or emotional market reactions. Gold and silver continue occupying distinctive positions within the global economy because they reflect monetary policy, industrial development, geopolitical realities, technological innovation, and investor psychology simultaneously. Their significance extends far beyond simple commodity pricing, encompassing broader questions regarding financial stability, currency confidence, strategic resources, and long-term wealth preservation. By examining structural trends rather than temporary volatility, investors may gain deeper appreciation for the forces shaping future opportunities within precious metals markets. Whether one adopts a strongly bullish outlook or remains cautiously optimistic, understanding these interconnected dynamics provides valuable perspective for navigating an increasingly complex financial environment. In the end, the story unfolding across gold and silver markets may not be defined by recent corrections but by the structural foundations quietly developing beneath them. Consolidation periods often feel uncomfortable precisely because they create uncertainty and test conviction, yet history repeatedly shows that major advances frequently emerge from environments where skepticism dominates sentiment. If industrial demand continues expanding, institutional interest gradually increases, physical accumulation persists, and long-term momentum remains intact, precious metals could remain important components of future investment strategies. The next major phase may arrive when few expect it, reminding investors once again that markets rarely move according to consensus expectations. Careful analysis, patience, and disciplined thinking therefore remain essential qualities for anyone seeking to understand the evolving landscape surrounding gold and silver. If you enjoyed this detailed market breakdown and found the analysis valuable, don't forget to like this video, share it with fellow investors and market enthusiasts, and leave your thoughts and opinions in the comments section below because your engagement helps build a stronger community of informed viewers. Subscribe to the channel and turn on all notifications so you never miss our latest updates on gold, silver, global markets, economic trends, and investment insights. Thank you for watching, thank you for your continued support, and we look forward to bringing you more in-depth analysis in our upcoming videos. Stay informed, stay patient, and keep learning.